Hello and welcome to this Forex Preview at xm.com. I'm Maria Pachardez, and joining me is Senior Investment Analyst Marios Hadjikyriacos. We'll be discussing the upcoming minutes of the latest FOMC meeting and the potential reaction in the markets. So Marios, back in June, the Fed shocked markets when it projected faster rate increases and signaled that it might take its foot off the accelerator soon. The minutes from that meeting will hit the markets on Wednesday. What clues will traders be looking out for?
Hello, Maria. Well, traders are really going to be looking at what kind of progress does the Fed want to see before it takes the next step in this normalization process. So right now, the missing piece of the puzzle is the labor market. The overall US economy is doing great, consumption is booming, inflation is hot, and it's doing so well that policymakers, the Fed, is worried that if it keeps its foot on the accelerator for too long, the economy could overheat. So they are trying to step on the brakes gently now, just so they don't have to slam on the brakes more aggressively later on. So what's missing before the Fed actually announces an withdrawal of some liquidity? It's the labor market. The Fed wants to see another couple of solid jobs reports, let's say another 1 million jobs report somewhere there, before it really gets the ball rolling in this process. And right now, as things stand, I think that we are very likely to get a strong warning signal about tapering in August, and the Fed might actually announce it in September.
Okay, so what will all this mean for the US dollar and currency pairs like dollar yen?
Well, when you start withdrawing liquidity, when you scale back quantitative easing, that's positive for the currency. Right? First of all, what is quantitative easing? Quantitative easing is very similar to cutting interest rates. When you're already at 0% interest rates and you can't cut any further, the way to stimulate your economy even more is to start buying bonds and do quantitative easing and asset purchases and so on. So when you try to do the opposite of that, when you try to do less quantitative easing, that's usually beneficial for the currency. So in this case, I'm looking for a stronger dollar, and especially against the currencies of central banks that will not be normalizing interest rates anytime soon. So things like the Japanese yen or the Swiss franc. So what am I really saying? If the Fed is raising interest rates, but the Bank of Japan isn't, rate differentials between America and Japan could widen even further, and that could benefit dollar yen over time. This is called the carry trade. It essentially means that investors that are looking for some decent returns borrow at very low Japanese rates, for example, and then they invest that money in higher yielding assets in the US. Ultimately, that drives demand for the dollar. And honestly, I think we might still be in the early stages of this process. I think that this whole trend could still play out over the coming years.
Marius, thanks so much. And thanks for joining us at xm.com.